I'll give you tips so that you can ensure that you don't run out of money. Avoid falling into the sequence of return trap, and that's because we can't control the markets, right? And the overall economy. As they say, it's not the direction of the wind, but the set of the sail. So I'll give you 7 ways to reduce the pitfalls of the sequence of return risk. Number 1, fix your asset allocation and diversify your portfolio. This is your first line of defense. Asset allocation is the overall blend of all asset classes. The most basic are stocks, bonds, and cash. However, how you blend these 3 basic asset classes will vary depending on your time horizon and your overall risk capacity. Keeping it simple, equities are risk-on assets, growth assets, while bonds are risk-off. They're more for stability. Risk management is not an on and off switch, people. It's a dimmer. The problem is a lot of people, including many professionals, still see risk management as an on and off switch that you turn off once you retire. There are multiple problems in this line of thinking, and I'll tackle that in a separate video, but it all boils down to the fact that even if you retired today, you're still an investor, likely for 20, 30, 40 years, and sometimes even longer, and you cannot turn all risk off because of inflation. Without growth, the purchasing power of your dollars silently diminish. Having the right asset allocation protects you from inflation and provides you with some buoyancy if the stock market drops. Once you've got the right asset allocation, diversification goes a level deeper. In essence, diversification is not putting all of your money into a single investment type. The idea is to have various investments that are uncorrelated or loosely correlated. You can do this by having exposure to different countries. Many suggest limiting your home country exposure to no more than 30% of your portfolio. You can do this by having different geographic pool focuses. Also, different sectors is important. Think of banking versus technology versus staple goods such as grocers. But one of the most alarming flags that I see when clients come to us for retirement is when I see executives who have highly concentrated positions in one company stock, their company stock, through stock compensation, and then they still go out there and buy the same stock in their RSPs, TFSAs, their personal funds. They buy more of the same. If you're in that position, look up any oil and gas company for those that wanted to retire in 2014, 2015. Imagine relying on a concentrated portfolio to retire with, and these cliff-like drops happen. That's the epitome of sequence of return risk. The next tip is simple, but difficult to execute. Employ a dynamic withdrawal strategy. It's really time to rethink the 4% rule. In fact, Bill Bengen himself has thrown serious doubts into this rule that he's made known. The 4% rule has been a staple for decades, but the economic environment that made this rule of thumb popular has changed. We are living longer, and markets are more volatile than ever. A fixed 4% withdrawal rate that's adjusted to inflation every year just doesn't cut it anymore. Imagine this is akin to you driving on a highway, your GPS tells you that you can go straight and maintain 100, but you see that there's an avalanche and you can't pass through because the mountain pass is blocked off. You won't keep driving, right? That's what adhering to a fixed withdrawal plan is like. You'll keep following it even if there's new information that's coming in front of you. Dynamic withdrawal strategies offer an alternative. This involves calculating your annual withdrawal rate based on current market conditions, your portfolio's performance in the previous year, and your changing financial needs. For example, you can implement retirement guardrails. This is popularized by John Guyton, where you adjust your withdrawal based on prosperity and poverty rules. Altering what you withdraw can rely on something as simple as deciding not to adjust your withdrawals to inflation if your portfolios have had a negative return the previous year. Or you can decide to increase your portfolio withdrawal if you have outsized returns beyond what your target rate of return was for the previous year. With our example, a dynamic inflation management changing nothing in the returns will allow portfolio B to exist and provide income for an extra 2 years. That's simply by adhering to a dynamic withdrawal strategy. For our next tip, you need to create a retirement income plan. It's hard to have a dynamic withdrawal strategy if you don't have an understanding of your own retirement income needs. Tailoring your investments to different retirement phases and different cash flow needs is important. Think of retirement as a 3-act play. Right? There's the go-go years where you're really active and you're doing a lot of the bucket list items. Then you slow down to the slow-go phase. And eventually when you've accomplished everything and energy is no longer there, in the 3rd phase, we call that the no-go years. Each act has different financial needs, risks, and opportunities. I'd like to add that your cash flows can also be dictated by your asset location. For example, you may plan to leave an inheritance and you don't really need to touch your TFSA. This may allow you to keep investing your TFSA in higher growth positions, risk on assets, even though you're already making withdrawals from your RSPs and RIFs and other pension accounts. Maybe you won't need to tap into the TFSA at all. Maybe not until your late 80s or in your 90s. So in that case, the TFSA has a different time horizon compared to your other accounts. This means you can treat the TFSA purely as a growth account even when you're already in your 60s. You can also consider implementing a bucket approach where your income for the next 2 years are in near cash accounts. Maybe it's in high interest savings accounts or GICs. Then you have a midterm bucket between 3 to 5 years of cash flow needs that are in stable fixed income funds. And of course, any cash you don't need for 5 years and beyond, you can have more exposure to equities in those positions. This all starts by understanding your cash flow requirements. I have a video breaking down how to check if you have enough to retire based on 5 or 6 different cash flow classifications that we use for our clients. You can check that out in the links below. Up next, set up your reserve funds. More than just having it for a safety net, a reserve fund goes beyond conventional emergency funds. It's your financial airbag in volatile markets. Having an accessible stash of cash or low volatility or short-term investments provides another layer of peace of mind as you enter into retirement. It enables you to cover immediate expenses without having to touch your main portfolio, offering a chance to bounce back after a market downturn. This is what the short-term bucket is all about. So this combines this with the previous tip. Another thing you could do is consider opening up a home equity line of credit. It's a strategic lifeline for you in case of a downturn. Other people call it a HELOC. This can be a strategic tool to navigate through financial turmoil. Let's say your portfolio takes a massive hit, but you still need money to fund your living expenses, right? Beyond your emergency reserves. Drawing from your HELOC temporarily spares your investments from being sold at a loss, giving them time to recover as the market rebounds. Let's say you need to draw $30,000 for your portfolio this year, and at the beginning of the year, you see your portfolio is down 15 to 20%. You can draw from the line of credit and pay interest only for 3 to 6 months, allowing your portfolio to recover. And then once it's back, you can then make your withdrawal from that portfolio and pay back the line of credit balance. You need to be an honest banker when it comes to this point, right? It's essential to replenish this line of credit during favorable financial conditions to keep this strategy sustainable long term. This strategy, frankly, staved off many portfolios in 2022. The next tip is about making sure you have a tax efficient drawdown strategy. See, this allows you to maximize your money with strategic withdrawals, because taxes are inevitable, but paying more than you have to is not necessary. Tax efficient drawdowns is all about timing. Should you draw from your taxable accounts first, your tax deferred accounts first, or tax exempt accounts first? The answer isn't the same, and it's not straightforward. It's not the same for everybody. It varies based on your current tax bracket, your expected future tax rates, and specific financial needs, as well as your expected return for your portfolio depending on where it's located. So this boils down to deciding whether you should access your RIF or your RSP first before your TFSA, or should you use your pre-tax non-registered accounts. A tax-efficient strategy aims to minimize the lifetime impact of tax liability. This allows you to stretch your retirement dollars as far as possible. Coordinating your withdrawals can save you a small fortune in taxes over the years. Sometimes this can be in the six figures depending on your situation. It's a little bit like chess, right? We all have the same pieces, but being strategic on which you move first can save you a lot in the long term. But conceptually, think about it this way. By reducing your overall tax drag, you will need to draw less from your portfolios to meet your lifestyle goals. The lower your target withdrawals are, the less impactful sequence of return risk is. Final tip, you need to make sure you seek professional guidance. I know this sounds really self-serving, but please consult a certified financial planner like yours truly, and make sure whoever you talk to actually specializes in retirement income drawdown strategies. See, you can DIY many things in your life, but fine-tuning nuances of sequence of return risk and withdrawal strategies requires professional help in most cases. Think of it as going to a specialist doctor when you have specific medical concerns. You want someone with the right expertise guiding you. Managing when you can increase your spending, or maybe even looking at when you have to tighten your belt a little bit, is dynamic, and it requires ongoing calibration. If you follow rules of thumbs and free online advice that's not tailored to you and your situation, you can end up running out of money. Or on the flip side of that, having too much left over. That's actually also a problem that could lead to massive estate taxes without direction, or simply ending up not really spending all that you would have been able to spend. We help our clients avoid this through our fee-for-service planning or our full-service wealth management services. Check the links below for a complimentary call with me to see if it's a fit. I just need you to understand that if there was a perfect time to hire an advisor, the 5 years before retirement and the 5 years into retirement has been proven to be the most crucial time to seek advice. I trust that you're leaving this discussion better equipped to face the financial landscape of retirement. Remember, awareness and proactive planning are your best allies in dodging the sequence of return risk. If you found today's video beneficial, share it with a friend that is also going to be facing retirement shortly. Your support helps us bring more quality content your way. For more in-depth insights into retirement planning, don't forget to subscribe and check the links below for the accompanying blog and cheat sheet. I go into a little bit more detail about the tips and strategies that you can use to avoid running out of money too soon. So what are your thoughts in today's actionable points? How are you thinking about retirement? Do you have a strategy? Please let me know in the comments. If you have feedback for future topics, please let me know. Until next time, we have more videos here so that you can stay financially savvy and take calculated steps towards retirement, the life that you've always envisioned. Happy retirement. Cheers to you. Bye.